if you look at historical pattern of how Fed interest rate affects the market, there's no correlation, right? The Fed has like changed the rates for like more than 100 times for the past so many decades, but the market in general, it's just going one direction, which is going up, because when you are investor, I believe you are long-term optimistic about human society in terms of progression, right? We believe that we are definitely going to strive better, and that's how economy develop, and that's how companies make more money, we become more affluent, and that's how the market goes up.
Hey guys, so we are back. Part 2 of our video with Chloe Lin, super rich options trader, joining us in the show. In the first video, she gave us her tips on what she's using on how she can become profitable especially in this type of market. Now, in this video, I want to drill in deeper. For those who are watching this, I'm sure you know what's happening around the world, inflation, tightening by the Fed, which has caused markets also over the past few months to not be as bullish as compared to the middle of 2020 or at some point in 2021. So, Chloe, here's my question. I want you to give us 4 tips that what should people do, especially people who are investors, should this drag on? Because people are talking about recession, that it might be something that might, people are saying that it's going to be even worse than 2008. So, what should people do?
In my opinion, I think it's important to continue to stay invested, because even though we can say that, oh, the recession is coming, the market is dropping, but seriously, nobody can ever have that crystal ball to see whether is the market really going to drop like another maybe 30 to 50%, or maybe it's going to rebound back, right? So stay invested, and if you can have more cash right now to buy more companies at such a wonderful price. I really think that so many great businesses, including Google, Meta, Amazon, has really dropped quite a fair bit. In fact, some of them are severely undervalued, in my opinion, if you are willing to hold for the long term.
You mentioned that prices are cheap now, and you also mentioned that there's a chance that it could go down, but no one knows how low it could possibly go. I guess my question that I want to segment on that, and this is where a lot of people are confused also, is that, okay, stay invested, but what percentage of my cash should I invest and what percentage should I leave? And when I say that, this is purely for investing already, separate from all of the cash that they have or all of the other assets. These are funds that are purely for the trade. Do they keep 10%, 30%? How does it work for you?
Yeah, I think usually we can, we also teach our students to look at the P ratio of the S&P 500, since we are talking about the US index, right? So we can look at the P ratio of S&P 500 to determine how much cash do you want to be holding onto it. And you can, if you observe right now, the P ratio of SPY, it's like about slightly less than 20. So actually it's much more undervalued, or much more fair as compared to how it used to be in the past, which is close to 20 plus, right, in the 25 range, right? So if this is happening, you should definitely have more cash invested in the market, and less cash reserved in the bank, right? So in my opinion, right now, at least you should be 50% invested and 50% keep in the bank. If you want to, actually, you can have even more cash invested, like let's say 60% to even 70% invested, because right now it is indeed a good opportunity. And if the market drop even further, let's say the P ratio drop even below 15, then you know that, wow, this is really a good time for you to use the balanced cash, right, deploy it and buy more. Yeah.
Got it. So stay invested, and then when it drops and P ratio goes lower, it gives you an opportunity to be able to buy it lower, add more shares, and accumulate. So tip number 1, stay invested. Tip number 2.
Tip number 2 is, I think during this period of time, especially right now, since so many businesses are undervalued, it kind of stay relevant to the first one, which is stay invested, but sometimes you do need cash to stay invested, right? So how do you get this kind of cash? I think it's also very important to continue to have income, right? Be it, I think a lot of people have this misconception that, oh, as an investor, you just 100% do trading and then you live off from your income from there. I don't think that's very sustainable unless you are, and I also think that it kind of will subject the investor to a lot of emotions, because basically your livelihood is just based on your portfolio performance. However, if you have another form of income, be it you work for somebody else or you run your own business, and that's when the cash flow coming in, I highly think that you should actually use this cash flow to continue to deploy to your investment portfolio and fund your account even more to reinvest, and that's how you let money work harder for you. So I think during this period of time, since so many people say that recession is coming, right? We also see there is signs of slowing down and stuff. Use this time to also upgrade yourself, upgrade your skill, so that you can acquire a higher income skill set for you to have more income to reinvest as well.
Good tip, no? And it's very, very important for people to try to find other sources of income so that they can use that to invest. I'm curious about your take on this. During this time that people are regarding it that there might be longer periods of bear, especially if rates go higher. Should people be trading more? Should people be investing more right now?
If you look at historical pattern of how Fed interest rate affects the market, there's no correlation, right? The Fed has like changed the rates for like more than 100 times for the past so many decades, but the market in general it's just going in one direction, which is going up, because when you are investor, I believe you are long-term optimistic about human society. In terms of progression, right? We believe that we are definitely going to strive better, and that's how economy develop, and that's how companies make more money, we become more affluent, and that's how the market goes up. So in the long term, I think at the end of the day, it's really about your investing horizon. If you are thinking about getting wealthy in 1 year to 2 years, then I think it's pretty hard. But then if you're looking at now 10 years and 20 years down the road, right now the market is so cheap, right? Because I totally think that 10 years and 20 years later, the market is definitely not going to be this level. It's definitely climb way higher, and if you can buy businesses right now, then why not?
Would you buy stocks right now or just buy property in Singapore? Because property in Singapore just keeps going higher also.
Buy both.
Got it. So tip one, stay invested. Tip number two,
yeah. Having the skill set to have that.
Find ways to find ways to earn so you can invest. So tip number three.
I think tip number three is, since right now there are so many volatility ongoing, people get very emotional when it comes to investing. Also use this time to read more, right? There are so many great resources, great books out there to level out your investing. You can read about how Charlie Munger, his investing philosophy, Berkshire Hathaway's AGM letters, Warren Buffett's. There's so many great investors insights that you can get by reading, and that really help to calm yourself down. And when you have that clarity and the right mindset, actually, in my opinion, at the end of the day, to become a great investor is to having that right mindset and the right stability, the emotional control, right? If you're able to do that, that which takes time, but you will definitely become a successful investor. So this is something that I'm also constantly working on as well. I constantly read a lot of different books, not just investment books, but different kind of books to level up my understanding in businesses as well. Yeah.
Got it. You've been mentioning this even in the previous video. You've quoted Warren Buffett, Berkshire Hathaway, now Charlie Munger. I'm just curious about this because you have a very, very good take that people should be continually learning. What's the biggest thing that you've learned from Warren Buffett's style that you have applied into your own trading and investing?
I really think that is patient, which is actually my point number 4, right? Because sometimes you also wonder, like, for example, 2 years ago, right? How come Warren Buffett did not deploy the kind of cash that he had? He had like more than close to $150 billion in cash that he did not deploy, and people are wondering why. The market is a V-shaped recovery, right? And he was patient enough to wait. And then recently, when the market started to tank, that's when he started to really deploy his cash to buy a lot of these businesses undervalued. So that really made me wonder again, like if we are just more patient. Like for example, I also get a little bit, like clouded by the bull, right? I was like, wow, the market keep on going up, I better should invest more. And then when the market pulled back, that's when I start to realize that there is just this golden principle of called patience. And if you're just patient enough to wait, right now the investing opportunities are even greater, right, as compared to 1 year ago. Yeah. And I think the patience also lies in not just in waiting for the stock to drop, but also waiting for the stock to go back up, right? Because if it's a great business, it will go up, but you do not know how long it's gonna take. And that's why it's so important that you really invest in businesses that have sound fundamentals, right? And for beginners, ideally invest in businesses that are already profitable, already predictable. That's how these businesses will recover faster as compared to businesses that are not profitable.
We were talking about trading, we're talking also about investing, and then you mentioned about companies that are undervalued. A lot of the companies that are cheap and are undervalued, when you look at the charts, they're pretty much bearish. They're long-term downtrends.
Yeah.
How do you reconcile both of them? That when you look at it, okay, it's cheap now, but it's in a downtrend. I think it's still gonna go
Even more.
lower. What do you do?
I will do dollar cost averaging down. So because I will never be able to know when is it bottoming out, and I will definitely regret if I did not buy when the prices are fair and cheap enough. So I will do dollar cost averaging when it actually drop. I will have my first tranche, right? So investors can consider allocating their bullets into at least 3 times. So if it dropped the first time, this is when you enter the first time, and it dropped, let's say, another 10 to 20% more, or if you want to use technical analysis to help you to enter, that's when you can enter the second tranche and the third tranche. And if you max out your allocation, you know that even though it can go even cheaper, I think it's also very important to be disciplined, to stick to your portfolio game plan. You do not want to keep on adding. What if the stock doesn't recover, right? Because we can make mistakes, right? But if you have a proper portfolio that is mix up a mixture of good companies, then even though 1 to 2 really go bust, then you know that the rest of it are still pretty decent companies that will go up in the long run.
Got it. You mentioned about making a good mix of companies. How many stocks should people buy? Because what I've noticed is the biggest problem with a lot of people is they buy too many stocks. And then for some it's not also really allocated well, that they buy a lot of this stock that it's bad, and then they buy a little of this stock, and this stock is supposed to be the one that did very, very well. So I guess my question is, for your portfolio, how many stocks would you buy as a maximum, and how do you allocate capital into each of them?
My maximum holding right now will be 15. In the past, when I first started investing, I also made the mistakes of buying too many stocks. Like there was a period of time that I have 50 over companies in different markets, that it's so hard to keep track. Basically, as when you have too many stocks in the portfolio, you are no longer a disciplined investor to even keep track of the company performance, right? So that's why it's so important, as we continue to level our investing, you should, instead of trying to diversify into too many where you have no capability of managing, concentrate into 10 to, I think, maximum 15 companies that whenever there's new earnings seasons, right now it's the earnings season again, then I have to be disciplined to check on the earning quarter, like the recent quarter earnings of this company, so that I know, is this still a good company for me to really consider holding on to, or maybe even add some more, right? Because the price has dropped and the company continues to do well, and if it has not maxed out your portfolio allocation, then you can add some more. So, and I think in these 15 companies, there are also tier 1 conviction stocks versus tier 2 or even tier 3 conviction stocks. That's when you need to understand where is your highest ultimate conviction companies, and that's when you are able to allocate more percentage into it. Because you believe in this business so much, right? And those tier 2 and tier 3, even though they are part of the 15, maybe you don't allocate 10%, maybe 5%, 3%, depending on your conviction to it.
$1,000, would you recommend people buy 10 stocks for $1,000? And then second one, if you say you have a very very large portfolio already, would you still stick to just 10 to 15 stocks?
I think so, because at the end of the day, if you see Charlie Munger, he only have 4 stocks. He only have 4 stocks that have high conviction in. So I think in terms of the stock choice that you will be choosing, it probably would not change. Okay, I don't have a $15 million yet, so I can't really predict what will I react when I was $15 million. But I believe
Just
the philosophy should not change so much, like how you manage a $10,000 versus how you manage $1 million. That's how you continue to grow. I don't think the investment philosophy will be changed very much. Yeah, unless you tell me that when you have, let's say, $15 million, I want to diversify part of the asset into different asset class, then I will understand. Like some in property, some in, let's say, cryptocurrency, and so that I think that's important, that you do not have everything into just one single asset class.
Number one, stay invested. Number two, find ways on how you can get cash to be able to invest more. Number three, keep on learning. Number four, stay patient in all of this. So this is my last question. Should people actually watch Arigato Investor in TikTok to learn more about investing?
Yeah, sure. I have a lot of very interesting skits, on investing, give you a lot of different investing ideas and insights. What's your favorite TikTok video of mine, Marvin?
Maybe the shoes one, the shoes or the watch. I think it was
The watch, the Rolex watch.
Yeah, the watch video. That's top of my head that I could remember. For those who want to learn more from Chloe, I'll put links down below on how you can watch her entertaining and very insightful videos on TikTok as well. So
yeah, we'll teach you about options and investing using very interesting TikTok videos. Yeah.
Got it. Thank you so much, Chloe, for joining us. But in the next video, our last video, we're gonna flip the switch. Maybe that Chloe's gonna ask me the hard questions. I actually don't know what she's gonna ask, so I'm very very scared. But if you guys enjoyed this, put a comment down below if you're learning and if you like Chloe to be back for more videos. And if you guys have any questions, feel free to put it down below as well. So there, thank you, Chloe, for joining us, and I hope you guys got a lot from this. I hope this video helps you trade well, trade strong, trade smart. See you all again soon, and God bless you all.